Why would a retiree pay taxes on purpose? Because the ones who get it right save tens of thousands of dollars. The ones who get it wrong watch the IRS devour their retirement. I am going to show you a tax move that wealthy retirees have been using for years. A Roth conversion strategy you can apply the moment this video ends. Why would you ever pay taxes before you have to? Let's find out. Here is what's waiting at 73. Mandatory withdrawals that can hike your tax bracket, tax your Social Security, and spike your Medicare premiums. The window to stop it is small. It opens the day you retire and closes the moment those withdrawals kick in. Smart retirees act in that gap with a Roth conversion. Let me introduce you to Jennifer. Jennifer is 63. She retired 2 years ago. For the first time in decades, her taxable income is low. So low, she barely fills the 12% federal bracket. She has a $700,000 traditional IRA, and she's been told her whole life to delay taxes. So she withdraws just enough to cover her living expenses, pats herself on the back, and waits. Meanwhile, a clock she can't see is ticking. When Jennifer turns 73, the government sends her a bill that changes everything. It's called a required minimum distribution, an RMD. The IRS forces her to start pulling money from that IRA, whether she needs it or not, and every dollar is taxed as ordinary income. That mandatory withdrawal alone will be around $28,000 in year one, and it grows every single year after. But that's not the real problem. The real problem is what that income triggers. In Jennifer's case, the RMD pushes her provisional income above $44,000, the threshold for a married couple filing jointly. Suddenly, up to 85% of her Social Security benefit becomes taxable. One extra dollar of IRA income drags 85 cents of Social Security into the taxable column. That's the tax torpedo. A retiree in the 12% bracket can face a real marginal rate closer to 22%, and she won't even see it coming. And there's one more landmine. At age 65, Jennifer goes on Medicare. Her premiums are based on income from 2 years prior. If her modified adjusted gross income climbs past $109,000, even by a single dollar, she triggers IRMAA, the Medicare surcharge. Her Part B and Part D premiums jump. That's a couple paying an extra $2,300 per year, automatically deducted from their Social Security checks, all because of a planning window they didn't know existed. Jennifer is sitting inside that window right now. This year, next year, maybe 3 more. A narrow gap where she could convert part of that IRA to a Roth, pay taxes at historically low rates, and empty the bomb before it detonates. The strategy is simple. Pay tax on purpose now to starve the IRS of future mandatory withdrawals. But simple isn't the same as easy, and if she converts $1 too many, she'll step on a landmine even sooner. So how do you get the math exactly right? That's where most people make the mistake. Let me show you exactly how Jennifer should think about this. She has a $700,000 IRA. She's filling the 12% bracket with room to spare. The top of that bracket for a married couple filing jointly in 2026 is $94,300 of taxable income. Jennifer and her husband report about $40,000 from a part-time gig and some dividends. That means they have roughly $54,000 of empty space in the 12% bracket. Every year she does nothing, that space disappears forever. So here is the move. Jennifer converts exactly $54,000 from her traditional IRA to a Roth. She pays 12% federal tax on that conversion, about $6,500. She pays it from a savings account, not from the IRA itself. Never use IRA dollars to pay the tax. That's an amateur mistake that shrinks the conversion and leaves less money growing tax-free. Now, why stop at $54,000? Because the next bracket is 22%, and the difference is steep. But there's an even bigger reason. Look at Medicare. Jennifer turns 65 in 2 years, and the government uses her income from 2 years prior to set her premiums. If her modified adjusted gross income crosses $109,000 for a single filer, or $218,000 for a couple, she triggers IRMAA, the Medicare surcharge. That's an extra $1,974 per person per year just for Part B. Add Part D and it climbs higher. And here is the kicker. Cross the threshold by $1 and you pay the full surcharge. It's a cliff, not a ramp. This is why the phrase "fill the bracket" is only half the advice. The real target is the lower of your tax bracket ceiling and the IRMAA threshold. For Jennifer, the IRMAA threshold for a couple is $218,000. She's nowhere near that, so the bracket ceiling rules. But if she were single, she'd need to stop well below $109,000, even if the 12% bracket would let her convert more. Get this wrong and you hand Medicare thousands for a conversion you could have done across 2 years for free. And this is where the strategy gets sneaky. IRMAA has a 2-year look back. The income you report in 2026 sets your 2028 premiums. So if Jennifer converts too much this year, the bill doesn't arrive until she's already forgotten the mistake. She'll open her Social Security statement in 2028 and see her monthly check reduced by the surcharge. At that point, the conversion is locked. The tax is paid. The premium is increased. No do-overs. But there's one more piece of the puzzle, and it's the one that catches retirees completely off guard. Jennifer's conversion plan works beautifully between 63 and 64. But once she's on Medicare, the IRMAA cliff becomes a permanent wall. Convert even a small amount above the line, and you pay the surcharge for the entire year. Yet the window before RMDs stretches all the way to 73. How do you convert during the Medicare years without triggering that surcharge every single time? That's where the math shifts from simple arithmetic into something much more strategic. And where the real difference between a smart retiree and everyone else becomes clear. Once Medicare enters the picture, the conversion math becomes a tightrope. Every November, Jennifer will sit down with her numbers and ask, how much can I convert this year without crossing the IRMAA cliff? For a single filer, the first cliff in 2026 is $109,000 of modified adjusted gross income. For a married couple, it's $218,000. Jennifer is married, so she has more room. But many retirees are single or widowed, and suddenly that $109,000 ceiling feels like a cage. Convert too little, and the IRA keeps ballooning. Convert too much, and Medicare drains the savings you thought you were protecting. But let me show you what happens if Jennifer does nothing. Let's say she leaves that $700,000 IRA untouched, taking only what she needs. Over the next decade, with a conservative 6% annual return, that account grows to $1.25 million. At 73, the IRS forces her first RMD. The formula is simple: account balance divided by life expectancy factor. Her first withdrawal, roughly $45,000, not $28,000. Add that to Social Security benefits that are now 85% taxable, and suddenly Jennifer and her husband report over $140,000 in taxable income. That pushes them from the 12% bracket to 22%, and their effective marginal rate, thanks to the tax torpedo, is closer to 40% when you count the Social Security taxation and the RMAA surcharge. That surcharge hits automatically. For a couple, $1 over the threshold, the extra annual cost is $2,300 in Part B and Part D premiums combined. Go into the next tier and it's $3,475. Year after year, and the RMD only gets larger because the IRS recalibrates the distribution factor annually. By age 80, the RMD could be $60,000, $85,000, $80,000. The tax bill compounds, and Jennifer can't stop them. The conversion window is closed. The money is locked in a taxable distribution schedule that will follow her the rest of her life. According to research from Covisum, roughly 60% of retirees see their tax rate increase after required distributions begin, and most of them never planned for it. They did what Jennifer almost did: deferred taxes aggressively, never imagining that the government would force them into higher brackets when they were older and less flexible. But here is the payoff that makes this entire strategy feel almost unfair to those who miss it. By front-loading conversions in the pre-Medicare gap, Age 63 and 64, Jennifer moves $200,000 from her traditional IRA to a Roth. She pays 12% federal tax on the entire amount, $24,000 in taxes today. That reduces her future RMD base by $200,000, plus all the growth that money would have accumulated. Over 2 decades, that single move saves her an estimated $40,000 to $60,000 in future income taxes, not counting Medicare premium avoidance and Social Security tax mitigation. Every dollar converted to Roth grows tax-free, comes out tax-free, and, critically, does not count toward her modified adjusted gross income in retirement. Roth is the invisible income that keeps her safely below the IRMAA cliffs forever. And there's one more piece that makes right now uniquely urgent. The current tax brackets are scheduled to sunset at the end of 2025. If Congress does nothing, the 12% bracket becomes 15%. The 22% becomes 25%. A conversion in 2026 could cost more even if your income stays the same. The window isn't just narrow in years, it's narrow in rates. Paying 12% today to dodge 25% later is not contrarian. It's arithmetic that beats the government's timeline. So how do you build your own conversion plan without making a single dollar mistake? The difference between a few thousand and tens of thousands in savings comes down to a precise bracket-filling strategy most advisors won't explain in plain language. That's what I'll show you next. The strategy isn't to guess, it's to fill. And I mean surgically fill the cheapest tax brackets available to you in each year before required minimum distributions begin. For a married couple in 2026, you start with your known income, pensions, part-time work, dividends, interest. Then you subtract the standard deduction, $30,000 for a couple over 65. What remains is taxable income. From there, you convert IRA dollars right up to the ceiling of the bracket you are willing to pay. 12% is ideal. 22% may still make sense, but stop at the lower of that ceiling and the IRMAA threshold. Never cross the Medicare cliff for a conversion. A single dollar over costs you the full surcharge. For Jennifer, that means $54,000 of conversion in year 1 at 12%, and another $54,000 in year 2. By the time she turns 65 and Medicare kicks in, she has moved $108,000 to her Roth. And she's not done. Once on Medicare, she still has 8 conversion years before RMDs. She slices those years thinner, converts $25,000 each year, keeping her modified adjusted gross income just below the IRMAA couple threshold. Over the full decade, she shifts over $300,000 from tax-deferred to tax-free, all at an average rate of roughly 12 to 15%. Now, what does that do to her future? Her RMD base is $300,000 lighter, plus the decades of growth she avoided locking inside the taxable IRA. Her first required distribution drops from $45,000 to roughly $32,000. That keeps more of her Social Security untaxed. Her marginal rate stays in the 12 to 22% range, and the IRMAA surcharge never arrives. The lifetime savings, between $50,000 and $80,000, depending on market returns and longevity. That's not hypothetical. That's arithmetic. But here's the detail no one tells you. The tax torpedo thresholds, the income levels that make Social Security taxable, were set in 1984 and never indexed for inflation. In 1984, $44,000 for a married couple was a solid middle-class income. Today, inflation has shrunk that threshold's real value by more than half. That means more retirees than ever are getting hit. And the average earner who saved diligently in a 401k is now squarely in the torpedo's path. This is not a rich person's problem. It's a saver's problem. And it's accelerating. I've put together a conversion window planning sheet that walks you through exact numbers, bracket thresholds, IRMAA cliffs, the years you need to act, and I'll link it where you can grab it. But the core idea is this. You have a short, precious window where you can pay taxes at rates that will look impossibly low 10 years from now. Smart retirees see it. Everyone else gets the bill at 73. The choice is already on your calendar. We spend decades chasing the tax deduction, and it feels like a win every April. But retirement flips the game. The deduction was never a gift, it was a loan, and the IRS sets the repayment schedule. The people who treat tax planning as a one-time event are the ones who end up funding the government's share of their retirement with money they assumed was theirs. The math is straightforward, but the window is not. It opens when your paycheck stops and closes when the mandatory withdrawals begin. Every year that passes without a conversion is bracket space you can't get back. So the question becomes, what will you do with the years you have left before the government makes the decision for you? If this video made sense to you, hit the like button and subscribe to the channel. And if you want the exact planning sheet I use to map out conversion windows, IRMAA thresholds, and bracket ceilings, I've put a special offer together. It's linked in the first pinned comment. Grab it while the window is still open. I'll see you in the next one.